if we never move forward,
Someone's gotta change.
you want riders, if we never riders.
Good morning, good afternoon. Hello, everyone. Welcome to this webinar guide to corporate offsetting, and a big thank you to Net Zero Markets for hosting this for us all. As you can see, just popped up there, we've got a poll, a series of polls actually, 4 questions about where you guys are in terms of have you participated with carbon credit purchasing, and if so, you know, what is your preferred type of projects that you like to invest in, and reasons for doing so. Hopefully that will all, we'll try and educate you on those kind of things through the session. That's what we aim to do. My name is Sam Hope. I'm a senior carbon advisor at London-based environmental markets firm Redshaw Advisors. My job is to educate voluntary carbon market participants and to help them develop highly credible net zero strategies and robust procurement practices and processes. So hopefully that does give me a position to moderate this session and try and show you guys how to get involved in the voluntary carbon market and avoid the pitfalls. But fortunately, I'm joined by 2 brilliant speakers who are going to help to demonstrate how you can practically get involved with direct project investment and trading on exchange. So first we have Claire Dorian from the London Stock Exchange Group. Claire, would you like to introduce your work?
Yeah, thanks, Sam, and hi, everybody. Glad you could join us today. So I'm Claire Dorian, I'm Head of Sustainable Finance in our capital markets and post-trade divisions at the Stock Exchange. So that is very much sort of the areas that are focused on our corporate listed companies, of which I know many of you online today are from. And also post-trade is the area that's focused on the clearing and the settlement side of our business. And really, you know, my role is very much focused on how we develop our markets to ensure that companies can raise finance with green credentials, sustainability, transition finance, and also how we can support those issuers in relation to some of the access to data and information and guidance around best practices in reporting. And last year we were very much involved in work around the voluntary carbon markets and launched a designation there. So I hope to spend a little bit more time today sharing more information on that. But thank you, Sam.
Thank you. We look forward to hearing about it. And then we have Zina Iqbal from Air Carbon Exchange. Would you like to describe to the audience a little bit about what you guys do?
Thank you so much, Sam. Good afternoon, good morning, good evening, depending on where you're coming in from. My name is Zina Iqbal. I'm the Business Development Manager for Air Carbon Exchange based in Singapore. My background is I'm a professionally trained lawyer with a background in financial services and regulatory law, having practiced in the United States for over a decade. However, at Air Carbon, I'm engaged on a daily basis with ACX members, as well as broader market participants, including project developers and folks like yourself in the corporate world who are trying to navigate this wonderful but sometimes overwhelming world of carbon and offsetting strategies. So a little bit of a jack of all trades in that respect. We certainly follow the markets, and I certainly follow the markets as well, but try to help out on navigating through this process. As Sam mentioned, education is a big piece of this. Air Carbon is a global carbon trading exchange, and the goal of Air Carbon is to reduce frictions in carbon trading, add in efficiencies, ensure integrity in the process, accountability, and we are built on blockchain, so we have immutable record keeping. And from an exchange perspective, one of our goals is creating essentially establishing benchmark pricing within the market that can help this market scale. I'll be talking a little bit more about exchanges later on in the program.
Brilliant. I think that exchanges are helpful in terms of transparency. Get it out there straight away. That's a word they're probably going to hear quite a lot today. So I just want to run through the poll results, which are relatively interesting, actually. We've got an audience where 3/4 of the audience have never purchased carbon credits before, but 50% of them are going to this year. So that's interesting. They all want to be educated on how to go about that, with an interest across all of the project types, really, and quality being sort of the number one driver for how they want to, what they look at when they're selecting their credits. So hopefully this is going to be super useful for you guys, and we've got the right sort of audience assembled. There's a Q&A. Just pop your questions. There should be a Q&A session at the end, maybe 5 to 10 minutes. So if you get your questions into the box, I'll try and pick through them as the guys are going through their questionnaire, their presentation, sorry. And just bear with me as I share my screen. Hopefully you can all see that now. Okay, so we're off. What I'm going to cover is pretty much the basics, the top level view on what offsets are and why you should do that, how you should take a look at offsets and the big pool that there is, and try and define what it is you'd like to purchase. And the other guys are going to go through a little bit more about the practical direct project investment and exchange-based trading. So first of all, it's essential that we get this portion knocked on the head, so everyone's at a level. So a carbon credit is issued to a project that can scientifically demonstrate that due to its project activity, a ton of greenhouse gas emissions have been either reduced or removed from the atmosphere. And these credits can then be traded and used through a process of retirement to compensate residual and unavoidable emissions of an organization or an individual. And that is called offsetting. That's defined as offsetting, the use of those credits against a footprint. Every carbon credit is created equally, and it is represented as 1 ton of carbon dioxide equivalent, which basically means that all the greenhouse gases are accounted for in relation to carbon dioxide, the most prominent greenhouse gas. But it's really important to highlight at this point the 2 distinct categories of a carbon credit. And we have an abundance, a large majority of the market of carbon avoidance credits, which means to say they're projects that stop further emissions entering the atmosphere. So they take a baseline scenario. Renewable energy is always an easy one to explain. We burn fossil fuels to create energy. If we're funding renewable energy projects, we're reducing the amount of fossil fuels needing to be burnt and reducing that amount of CO2 going to the atmosphere. What we're looking to transition to, the closer we get to 2050, is more carbon removals, whereby projects physically take CO2 out of the atmosphere and store that away permanently, so removing it from that carbon cycle. We have a marketplace dominated by the avoidance, as I mentioned, maybe 98% of total volumes available. And we'll see that kind of shift as we go through the years. But that's an important base level to get to for us all. And here's another interesting table on the right, which I'm going to come to. But first, why would people do this? Why are people going to participate in offsetting? There are a huge number of reasons, but I guess they come down to things like reputational benefits for doing it, and that's whether reputation in the eyes of your customer or even your employees, whether you've got a commercial benefit that you want to get out of this, a competitive advantage, different market opportunities that mean you have to have a net zero strategy or an ESG strategy. Legislative reasons are going to start to come in the future. So you're starting to see businesses prepare for that from a sort of governmental regulations point of view, but also if you're part of a supply chain that demands something of you from a sustainability point where you need to make clear and obvious what you're doing, then that's a level of legislation that you'll kind of need to adhere to. But ultimately, I think the main reason that everyone should and is that we're starting to see now getting involved with offsetting is because of decarbonisation and it being part of a driver for carbon reduction and effective net zero communication. So this table on the right represents terms that you will have heard. They're fairly well established terms. And I just wanted to touch on these just so everyone's clear. Carbon neutrality, one of the biggest claims that people have made for many years now, means a matching of your carbon footprint with carbon credits and of equal amount. Now, usually that's always been those carbon avoidance type credits. So you're stopping further emissions entering the atmosphere and matching that with the emissions that you couldn't remove from your operations. When we talk about carbon positive here at Register Advisors, we talk about taking that action to another level, 2-3 times offsetting your footprint, using typically, again, those avoidance type credits, which aren't removals. Removals is what's going to be required for a net zero position, where what's going into the atmosphere is matched with what's coming out. And when we reserve carbon negative for a position of going to that net zero style of offsetting and going 2 or 3 times over, a position that from 2030, someone like Microsoft aims to be carbon negative. So we see it often as something after a net zero goal, whereby you will be starting to take away some historic emissions that you had built up, similar to the Microsoft model. Selecting for buying. This is, I guess, the key reason why a lot of people are going to be on this this webinar today. And the real problem is the choice. There is so much choice. People don't know what project to support, where to start, if they're getting good value, and that leads to a lot of stasis and people not really engaging and getting involved. If we look at the 2 biggest, most recognized registries, and that's Verra and the Gold Standard, you've got about 4,500 projects there, individual projects to choose from, and 1.2 billion individual credits for which to buy. So that choice is huge. But if we took approach of looking at all of that choice, using a framework such as this is the one we kind of advise our clients to go through, a process of selecting, criteria that that are ranked in terms of their influence on carbon credit pricing. Then we'll work with customers to say, okay, firstly, what project type are you interested in? Here's a kind of few examples. There are many, from reforestation, afforestation, blue carbon, soil carbon, red plus, and renewables, all of these types, which are all different flavors. They have different, many different characteristics, but they will be the fundamental driver of what pricing is going to look like for that 1 ton of carbon. Following that, you've got, where in the world are these taking place? The regionality that might be specific to you as a business. You may have operations in Latin America, for example, so that would be a region of interest. But of course, different parts of the world, there'll be different costs implied on the implementation of projects and the availability, the number of other projects in that region, etc. Next, you've got vintage, which is a very interesting debate. Vintage can be brought into the quality debate, and we're not going to go there with this session, with this slide just now, but vintage effectively means the year in which that carbon credit was created. A project may get a crediting period of say 10 years. So they can, every year of that, create a different vintage and issue X number of credits for that vintage, which often means, and older vintages are seen as a discount for the latest price. Businesses would like to match 2022 carbon footprints with 2022 offsets, because that looks the best, I suppose. It matches with emissions reductions happening in the same year. But if budget becomes an issue and you like a project, you can look back through previous vintages to find more affordable pricing. Then you've got the registry in which it's housed. There are the big 4 registries, ACR, CAR, the Gold Standard, and Verra, plus many others that are emerging throughout the years. And they will have a slightly different cost associated in general with their projects. And finally, you might want to look at additional SDGs and other co-benefits or charitable links that are associated with the project. This refers to the levels of community and biodiversity involvement that you have with those projects, and strong strengths in which you can communicate with your with any achievement. So best practice. The key things are, this needs to be, offsetting needs to be part of something wider. It needs to be part of a big plan. It doesn't stand up anymore to simply go out there and purchase offsets and make a claim. People are becoming more educated and wiser to its role, and net zero is becoming clearer, and how it's a strategy, it's a strategic approach and a long-term roadmap, whereby things like carbon neutrality can be annual checkpoints, annual achievement periods where people can celebrate having reached something, but it ought to be part of that annual cycle of reduction and an accountancy piece at the end of a year. Seeking help. This is a self-regulated market. There are lots of participants, but there are lots of people who would who can help educate in the right direction. You're totally allowed to go out there and stand on and self-validate yourself with claims, but it helps to get that third-party perspective. Get to know your projects. That's of course key. Spread your risk through maybe blending various projects into a portfolio. Understanding that claim, so going back to one of those previous slides there where you have the different claims, and making sure that the credits you've bought fit the claim you wish to make. And full transparency, communication, internally, externally, that's super key. So this is what we're going to go through today, and the other guys are going to take that direct line and the exchange based access to the market. I'm just going to cover off in the next slide a little bit about retailers, but that's the one that is probably most common in most people's minds, because you can internet search and come across. But effectively, we want to try and get access to those credits at a carbon project level. So what are the different options available to you? Retailers, these guys have been about for a number of years, and there are hundreds of websites or tools that you can use in order to get good access and good color on projects. Anything 1 to 1,000 tons is probably a good point of call to be going to a retailer. If you have a small volume demand or a regular volume demand, they're good for this, for picking up volumes. There's often good level of marketing material, certification, and project information. The negatives perhaps is there can be a huge range of prices and margins from the retailers. It does require you guys to be pretty well educated on what you're looking at, and how to navigate all of those project selection criteria that we mentioned. And there will be lots of participants with unproven track records, or very short, they haven't been on the internet too long, and it's sometimes difficult to work those out. So shop around, try and identify those credible suppliers, try and see if they have transparent sellers pledges, demonstrating flow of funds, making sure money is going back to these projects. Ask for all of those details that we mentioned previously, and try and get yourself so the process of retirement means usually a retailer will go away on your behalf and cancel the certificates so that they've been used for your claim. And you want to leave a retirement comment at that point. Retired on behalf of Sam Hope for Retro Advisors 2021 carbon footprint, for example. So leaving some comment that can be up there for all time on the registry. And at that point, I think it's a nice part to, I'm just going to stop my screen share and just check whether we had any, well, I think we will move forward onto Claire's part, where it's how do we get to the projects themselves. And so if I allow you, Claire, to screen share.
Thanks very much, Sam. Just bear with me while I get this up then. Hopefully it's going to work. I know that there were a couple of
Yep.
technical problems with getting the slides shown before. Is this one working okay?
Yep.
Good stuff. Okay, all right. Let me share just, so I only got just a few slides really, but so, and I think that the intention is this is all going to be shared afterwards anyway. But I just wanted to give you sort of a snapshot of how the London Stock Exchange has been approaching this. You know, Sam, you've already done a great job of sharing, you know, the scale of the climate crisis and how we need to use all the different tools that are available to help to reduce global emissions. And we know that carbon markets are a proven tool for deploying capital into climate change mitigation projects that we know otherwise would not be financially viable. And when we looked at how the London Stock Exchange could help to support and scale the voluntary carbon markets, we really came at it from the angle of, well, what does the London capital markets do? You know, we already are about providing sources of capital with those that need it. We don't trade, you know, commodities on the London Stock Exchange markets. It's equities and fixed income securities. So we think that the way that we're tackling the challenge of how do we scale the markets here is from a financial point of view. So what we have focused on is enabling funds and companies to be able to list it on the London Stock Exchange's markets that are investing in climate change mitigation projects that will potentially deliver a carbon credit in the future. And many of these projects, you know, are going to be located in emerging markets and developing countries that really need significant capital to fund those low carbon sustainable development programs. And those projects can generate carbon credits and they need that revenue stream to become very commercially viable. And this is really sort of where I think, you know, Sam, you talked a little bit about, you know, the concept of additionality and that we're providing opportunities to finance to go into those projects that need to be able to generate carbon credits, and those activities would not take place as business as usual. So the designation that we really have focused on creating has got those key drivers of having those outcomes that are there on the slide, increasing the flow of finance into activities and also providing investors with the access to carbon credits in the future. See if I can move on these slides okay for you. Now, the way that we've looked at it, though, is that, you know, because, you know, in our minds, you know, the voluntary carbon markets are very much a vital complement to net zero strategies that are being set by large and small cap companies globally, and it can support that climate action and the decarbonisation that is taking place within businesses that, Sam, you said quite rightly, is really being focused on and is looked at from, you know, some very robust science-based targets that are being set to reduce their direct and indirect emissions. But, you know, the voluntary carbon markets here can help to achieve some of the challenges of meeting those full net zero targets. And sometimes, you know, there is some complexity around sort of the buying and purchasing of credits, and needing to have sort of transparency and governance really helps to give, you know, stronger assurance to those participating in the markets. And I think this, through the way in which the London Stock Exchange is setting up the designation, brings a public market and level of governance and transparency that is not necessarily sort of the way that the market has always operated. There's obviously lots of different routes of entry today. You know, London Stock Exchange Group, we purchase carbon credits ourselves and have done that historically through brokers. You've got funds, private funds, you've got opportunities to directly invest into projects as well. But I think, you know, it's about giving variety and optionality for investors in the future. That is really what we're looking to achieve with helping to scale this market, and ultimately that end goal of how do we support climate change mitigation. But so let me just try to be, you know, focus on what the option that we've set up through the London Stock Exchange markets is, and how that will work in principle. So at the moment, if you have a vast variety of renewable energy funds on our markets, for example, and those need to IPO, they need to use the listing rules of the FCA or the emission rules under AIM. And so we're setting the designation requirements up within that market infrastructure and rule environment. So you would see that you'd have a listing, either a fund or an operating company, onto our markets. And then in addition to that, in order to receive the designation, then they would need to meet certain standards and requirements that we've baked into our admission and disclosure process. So you've already got, by the nature of having gone through an IPO and all of the validation, the due diligence and the governance that's required with that, those vehicles are going to meet the public market regulatory disclosures and corporate governance and market abuse regime. So really, you're marrying here together sort of the world of the equity capital markets and regulation with the voluntary carbon markets. And then what we've set really as some of the key fundamentals in the emission and disclosure standards is that you've got sort of an overarching principle that sits around this on disclosure and access to information. So, this is here about not us as the exchange setting ourselves up as a new standard body, but actually that we've identified reputable industry bodies that do set the standards for projects. And we have set ICROA or the ICBCM as that becomes developed in time. And we require those issuers to apply one of the standards to their projects and report against some of those key matters on an annual basis. And so those standards are setting out the methodologies, the due diligence, the verification. I think the advantage of that approach is that those standards have been set, they've been verified by those independent bodies, and then investors can understand the quality of the carbon credit based on those principles and understood standards. And there, we also just require, in addition to disclosure around the standard bodies that are being reported against, but also annual updates on information like carbon yields and where the project's taking place and location. So ultimately, what you envisage, we'll see sort of emerge on the capital markets in time is, hopefully sort of a multitude of different funds that will be listed and could use this as a route, or operating companies. And that you've then got choice as investors as to the types of funds that you're investing in. So you could have a fund that is invested in afforestation and forestry, or you could have some that are very focused on a multitude of different nature-based projects. And or in the future, in time, carbon capture projects. So where this is today, this was launched only back in October last year after full consultation with various different market participants and industry experts. So we're at early stages for us in terms of the evolution of this, and we have one fund that has received the designation called Foresight. Sustainable Forestry Fund. They were listed on our markets actually back in 2021, involved in afforestation and forestry projects and recognised by the UK Woodland Carbon Code. Just an example of the types of vehicles that we would expect to see listed in the markets in the future. But we really want to make sure that those have full sort of disclosure around the project types. I think this is quite a nice sort of visualization and infographic of sort of explaining sort of the process of how kind of coming in and coming out. What I haven't focused on so much at the moment is we know about the sort of the listing and the admission process. You have the vehicle on the market. That's really going to be some project developers and fund managers working together to support an IPO transaction on our markets. But what actually happens once they're on market? Really, it's going to be trading as an equity share. So you as an investor can invest in this. So corporates, we think, are going to be fundamental investors into these vehicles and will really be cornerstoning. And would be purchasing and owning an equity share. So you can trade that in the secondary market on the exchange. Then what potentially can happen in the future is that you could have an option to be able to receive carbon credits in the form of a dividend in specie. And they've got, the optionality around that as to whether those are retired against the residual footprint, or whether they're sold through OTC methods or carbon exchanges, or they're held or retired at a later stage. And that is something that is very much worked through with the fund managers as well. And we do see sort of that investor base typically sort of in funds as being very institutional focused, but this is a very new way in which we think you'd have more corporate and maybe even retail investors into these vehicles, with that goal of then ultimately holding something like this on balance sheet and on your as a finance function. And we know that to date, very much of the carbon procurement process can be carried out by marketing and sustainability teams, procurement teams, but one of sort of the market dynamics and shifts here is around it becoming more financial function, more treasury function. And so I think this as a way in which the procurement process can take place as an option in the future plays to this strength around finance and treasury functions becoming a way forward. So look, I think some of this I've kind of probably covered a lot as has been talking already. I think it's clear around some of the benefits that this brings from a pricing perspective and visibility. You need to have clear transparency on the disclosure of the project development, the performance of it, and the cost of capital as well that is being sort of impacted here. I think it does enable the procurement process for offsets for corporates to be quite transparent, because it's going to be the fund manager and the project developer working together, and the vehicles that then in turn are listed on our market. You can be confident in the due diligence that has been undertaken. So I think this is about giving some optionality to investors to be able to participate in the market in a slightly sort of different way. What will happen in turn in terms of sort of the receiving of the carbon credits and where those get traded, that to date wouldn't happen within the London Stock Exchange's market. So that is something that would happen elsewhere. But I think an area that is of growing interest to us as an organisation is the carbon markets, because we think we have a role to play here, certainly in scaling up finance into projects. But also we have another part of the business that's called Point Carbon, that's focused on a lot of the data and the analytics and the pricing. So that can really help to sort of make people sort of get a deeper understanding of the market and some of the sort of future projections. Well, just conscious that perhaps some questions may have been coming through in the chat that I haven't picked up on, but very happy to take any questions now, or if you want to follow up with sort of one of the team at a later stage. We're very much sort of in the mode of how we're turning this into a success and to support multiple different listings on our markets. So there's a lot of conversations that the team and we're all having with project developers, with the fund managers, with investors, and the wider ecosystem. So happy to follow up with anybody at a later stage.
Thank you very much, Claire. It is obviously a timely solution. The voluntary carbon markets 2020 and backwards used to be just a spot market that people would dip into. Now, obviously, we saw 2021 massive price rises and a lack of supply. So people started to think, how do we get ahead of this? How do we invest in projects? Solutions started to come about. This is an interesting one whereby smaller investors could potentially get involved and launch projects. And 2022 saw the quality become part of the conversation. Another reason why individuals might want to get that to that ownership level or to that funding level and get projects off the ground. And I imagine it's you're largely going to be looking at, you mentioned afforestation and reforestation. I think we've got a couple of questions that we'll try and get in, but I want to be conscious to allow Zina enough time to do her presentation. So if we go there, and then hopefully we can double back on a few of those questions about what types of projects we can get off the ground through that system.
Thank
you. You're muted, Zina.
Thank you, Sam.
Thank you.
Thank you, Sam and Claire. I think that was a really great overview of the markets, and helps me segue into the next few minutes of what I'll be talking about in terms of exchanges. I wanted to actually start off to talk a little bit about products and build on what Sam had mentioned earlier in terms of the types of products that you would be looking at from a corporate perspective. I started out with my introduction, talking about how the carbon world can be very overwhelming, and there's a growing number of people that are becoming experts in the field, but there's also a much larger number of folks, particularly in your position, having to figure out a sustainability plan and having to navigate a carbon market that can be very confusing. And so I want to just talk very briefly about how we are trying to make that a little bit easier through the exchange process. And the carbon exchanges, Claire very rightly pointed out, the London Stock Exchange is not a carbon exchange. There are actually carbon exchanges that are coming up, one of which is Air Carbon, to specifically cater to this market. And they're built on a commodities style architecture, and they work in the commodities principles. So again, to talk a little bit about how it all works, Sam pulled up, had a couple of different criteria: registry, the type of project, the vintage, the region, any potential co-benefits. Now, all of these together are probably what you're all thinking about in terms of your corporate sustainability strategy. But the question comes about, are you going to do due diligence in every single project? And what is the criteria you're going to look in terms of figuring out which vintage is better than another? As Sam rightly pointed out, there you might want to match your vintage to your offset. But apart from that, is there any reason to pick one vintage over the other? Or do you have a regional footprint, for example? Or how is the offset generated? Is it a renewable energy, nature-based? There are many types of nature-based. There's a forestry management. There could be REDD+ projects, reforestation projects, so on and so forth, and of course, household offsets, cook stoves, and those that have very high social benefits. And we're learning more and more about high technology intensive processes, direct air capture, carbon capture and sequestration, and so on. So the choices are growing, and now you have to figure out, okay, how do I move forward with this? So this is kind of what the carbon market looks like in terms of everything that's out there. If you looked at it all in just a kind of from a 30,000 foot view, you'd see nature-based, you'd see renewables, you'd see all kinds of different projects. I didn't have a good cook stove icon, so I couldn't put it in here. What we're trying to do is called standardization. And again, we're borrowing from the commodities world in terms of commodities contracts. And so all the renewable projects have generally the same, should have the same value in terms of the market price, and have similar characteristics. So for example, I'll give the example of the CORSIA contract. And the CORSIA contract is the most widely recognized and traded carbon contract. And it is what is established by, rather formulated by, the International Civil Aviation Organization. And what CORSIA does is it's three different parts, one of which is offsetting. It basically requires certain airlines under the mandate to reduce their emissions, their GHG emissions, have a reporting protocol, and to offset. And it's that third part that is really most relevant. That mandate requires airlines to not only offset, but to offset using certain types of credits. And what that does is that creates that is a carbon contract in of itself. It has a definition on vintage. It has a definition on registry. It is a global contract. There's no regional definition. It doesn't have to have one. And there's certain technology exclusions from that. And there's actually a vintage range in terms of project establishment. So that's an example of an industry standard, industry defined product. You could also have standardization around these different technologies. You could have a standardized product around renewable energy. Air Carbon has a contract called the renewable energy contract. There's standardizations around nature-based projects, which you may have heard of very actively in the news. And those are so some of those products are available on Air Carbon Exchange. We have two different types of contracts. One is called the Global Nature, which is a base contract for a certain vintage period. And there's actually 3 vintage periods. And then there's also one with premium benefits, something called the Climate, Community, and Biodiversity Benefit Certification. And this just, emphasizes that this is just not about carbon and offsetting, but it also touches a lot of other factors, and it's not siloed into just carbon. CBL Markets is another, has a standard contract called the NGO, which also covers nature-based projects within a certain vintage that have certain co-benefits. And these are the criteria that we're kind of looking at. Another popular project type product is designed around cookstove projects. And this is a very specific subset of projects. Air Carbon has what's called the household offset contract, and CBL, for example, covers, I think it's called the SDGO contract. So again, it's not just a specific technology with a vintage requirement, it also has a base number of SDGs that the project has to obtain. Moving into that, we can also design a contract or a product around a certain number of SDGs. And we have one on our exchange called the SDGT, which has a base of 6 SDGs. There's also a very unique type of product that was recently launched by Net Zero Markets called the Global Emission Reduction, which is designed to make offsetting simple and accessible, particularly for corporate offsetters, by offering a single global reference price. And the GER is basically made up of a subset of 4 contracts that are in fixed weighted averages covering all of the product types we talked about earlier. Renewables, forestry or nature-based projects, projects with additional benefits, really highlighting the social benefits of carbon projects, and a carbon capture projects, which covers, the long-lived removals of carbon emissions. So you've got avoidance and removal in a portfolio that has a weighted price that makes it more accessible to corporates. Carbon capture projects can be, anywhere from $50 to potentially $1,000. It can be quite a high price. But what the GER does is, with its weighted approach, it brings everything together to a more normalized kind of global carbon price. And the portfolio approach is often what corporates are thinking of doing themselves to again weight out the cost of carbon, touching a little bit on renewables, touching a little bit on high intensity technologies, and so on and so forth. So I just kind of went over these, and I apologize I didn't go through them quite in sync. We follow the industry standard, follow certain technologies, look at and so on and so forth. And I've identified here some of the achievable climate goals, and for touching upon like some of the nature-based and some of the other contracts here, some of them can actually constitute removal. There are some nature-based projects, such as afforestation projects, that are considered removal projects. There, at the moment, is no unique product for carbon removal, at least not in the exchanges that we're talking about. There are marketplaces out there that have carbon removal projects that are available on more retail basis or in the OTC market. Just a quick kind of snapshot of the exchange traded products, and the 2 key exchanges are 4 standardized projects, are ACX and CBL. The CTX, which is a London-based exchange, also has spot trading, which is on a project-by-project basis. It doesn't follow the standardization method. Why is standardization, I think, helpful to corporates is as the market moves from offsetting from being kind of a marketing kind of avenue, or sitting with the marketing department, sustainability department, so on and so forth, more and more as I think it was Claire or maybe Sam mentioned earlier, that it's going to become more of a regulatory piece. And it's going to become more of a compliance piece where particularly listed companies, perhaps even non-listed companies, will be required to make climate risk disclosures. We're seeing that already in many parts of the world, where there's no requirement to necessarily do anything. In some places there are, but for the most part, the disclosure requirements is just to say what you're doing. You can choose to say you're doing nothing, but you have to disclose it. And we often see that disclosures from a regulatory perspective do start moving the ball in terms of the direction, at least in this case, climate action. I'm going to take away I'm going to stop sharing here for a second, and I'm going to take the opportunity to actually go into the Air Carbon Exchange just to do a quick demo, 2 or 3 minutes of just showing you how easy it is to trade on a spot exchange. Just to again highlight, what do you need to get on an exchange? You need a membership, an account, which is the same as potentially a retail type of account. However, as we again move into more regulated exchanges and exchanges such as Air Carbon and CPL and so on and so forth, these are financial instruments, and there are certain KYC requirements and certain requirements to go through to clear AML, CFT type of screening. We trade in US dollars, for example, and there are certain cross-border transaction requirements that you have to meet. So you have to start an account. Typically, you need a corporate account. Some exchanges require you to have a registry account. At Air Carbon, you don't necessarily have to have a registry account, but it depends on the exchange you're working with. There are certain price efficiencies and low costs in terms of transaction costs that come up with trading on exchanges, and of course the standardization kind of takes a little bit of the diligence. It's not diligence necessarily, but it takes out a lot of the overwhelming factors. If you know you want a cook stove project, you know that you want a certain vintage, you can actually come in and procure it in an exchange format. I'm going to just share my screen here. I think that you should be able to see my screen. Air Carbon is thank you, Sam. Air Carbon is a web-based platform. So you come in here, you would sign into your account. We have a great kind of dashboard that kind of gives you a full snapshot of the assets that you hold. It shows you your US dollar balance. These are the different types of contracts we have. It's not the full list because this is just a demo, and the names of the projects, et cetera, may not be completely accurate either. But this just shows that you can toggle between the different contracts and demonstrate how you can kind of see your digital assets. Each one of these digital assets is essentially backed by a single carbon credit, and you have all the metadata associated with that credit right here in the back end. Now, these are projects that I own. They're held in a carbon trust under ACX. I have the digital asset. Again, we borrowed from commodities architecture, where we have the quote unquote physical in a warehouse, and the exchange essentially issues a digital ticket that evidences my ownership of these credits. I'm going to go into our spot exchange just to show you. This exchange is designed, again, very much following the financial market. So many of you will be very familiar with this type of structure. We have a T0 settlement on the exchange. Essentially, we can settle in about 30 seconds or less. On the left-hand side here, you can pick your product, some of which I mentioned earlier, the global nature, household offsets, Corsia, and so on and so forth. There's an order book that shows all of the bids and asks. Now, these bids and asks are entirely driven by market participants. There is always going to be a counterparty on the other side. Just say you come in here, you've already done your due diligence. You say, okay, I'm going to get a Corsia credit. I'm going to get, say, 5,000 tons. We trade in lots of 1,000. And the fees, like I said, are very, very low. For this trade, for 5,000 tons, you'll be paying $25. It equates to about half a cent per ton. On the OTC market, it is very difficult to get this kind of pricing efficiency, as well as in the retail space as well. One of the challenges, of course, if you're buying less than 1,000 tons, you would go to a retailer. As Sam mentioned, that's probably going to be your best bet. I'm going to go ahead and place my order. My US dollar balance is 241,000 in my demo account. I wish I had that bank balance. And I go ahead and press buy over here. And you can see here that the system is going to actually process the order. A couple of pop-ups here. there's no liquidity here. So that's why basically that's a failed trade because there's no sell order. As I mentioned, the counterparty is always on the other side. So I'm going to go to another product here to actually show you how I'm going to actually process the purchase, hit place order. Here, this one is going to go through. I'm going to see if I can buy this couple of few orders over here. The pop-ups will come up again at the bottom of the screen. It's been submitted, it's been filled, and you'll see here in the trade history, it's been matched. These are the 5 contracts that I will be matched with. And one by one, they will confirm as we are watching here. It takes, like I said, probably 30 seconds all in all. There's 2, there's a couple more coming through, and they'll all match. I can go into this trade ticket and actually see the project that I have now purchased. I did it too quick. Let's see again. So now I can see the project that I've purchased. All of the metadata that I saw in my dashboard is right there. And I now will be able to go back to my dashboard, and it'll be automatically put up on that end. You'll see my US dollar balance has reduced. It was 241, it's now 215. And my ANT balance, which I just purchased, will be increased by 5 over here. So this is a fairly simple process, again, very efficient. If you have a good sense of the types of carbon credits that you're trying to purchase, exchange traded options, products are quite helpful, and I think can be very efficient. More than happy to answer questions about the process.
Thank you very much, Zeenat. Very helpful for at least me. I'm an advisor, not a trader, so that was nice to see that little demo. And I'm sure, well, we do have a lot of questions. Firstly, apologies for my slides not changing for everyone, but they've been popped into the chat, I think, and we'll make them available afterwards. We do have some questions. I know Claire was trying to furiously answer a few of them alongside. I think, Claire, you've got quite a lot, but maybe a price one for Zeenat. We currently see prices of $3 per megaton of CO2e. That does not allow you to do anything apart from avoidance projects. Do you see differentiation in pricing for actual removal credits using nature-based solutions?
Absolutely. We see a huge differential of pricing. Yes, we certainly are seeing very low prices for carbon offsets, particularly again in the standardized form. What ends up happening is there tends to be a vintage bucket, so say 2016 to 2020. And what we're seeing is that the lower end of that tends to dictate the price. So we're seeing prices for 2016s and 2017s in the nature-based, for example, at these very low prices of $4 to $6, which is quite surprising. But then you actually see, from a vintage perspective, that price actually goes up in the 2018 vintage. You sometimes see 3, 4, 5, sometimes double the price of what you're seeing on 2016 and 2017. Specifically on afforestation, or the nature-based removal projects, those are certainly seeing premiums because they have an additional value add. They are they're a new forest that are creating new sources of new sources of removal, and it has a greater length of time, a greater lifespan as such. So all of that is factored in. Claire had a great slide about what goes into the pricing of carbon projects or the valuation of carbon projects. The same goes into the pricing of individual carbon offsets. Yeah. So that's a great question, though. Thank you.
I think nature-based removals are not that plentiful, not that liquid a market. We don't see many products created around it just yet, but certainly they are north of $20, $30 for good afforestation projects. There were a number of questions for the related to the LSE. I think one left up there is getting credits from LSE VCM only going to be through dividends? You might have answered this one and a number of the others, but maybe Claire, if you can cover the questions that were asked.
Yeah.
Thank you.
Sure, will do. So I think I answered a couple of them on the chat already, but this one, yes. So the way that we expect it to work in practice is that you're purchasing and holding a share, so an equity share that could issue a dividend, and that dividend might be in the form of cash, or it might be in the form of a dividend in specie carbon credit, and that really is the mechanism in which those credits would be in turn received by the owners of the shareholders in the funds. and then the decision is made between the fund manager as to whether those are issued in that way, or whether they are going to be traded, or whether they're going to be retired.
Thank you very much, Claire. There's a question from Parag about how do we know that purchase offsets have actually done their job in terms of avoidance or removal, and what happens if there's a shortfall in CO2 in the project versus the forecast. This is a bit about the project design and how registries work, I think. So the frameworks in place are to assess projects on an annual basis through verification by a third party. If at that point that third party discovers that the project has underperformed, it will only it will go to the registry and say that the project can only issue X number of credits based on its performance. So credits are delivered retroactively on the project's implementation. So it would need to be approved, and they would just get an adjustment to the number of credits issued to that account. So it's done there. There's also another mechanism at registries where there's a buffer pool. If a project were to go on to fail later or during that year, so there would be a further insurance, but hopefully that covers up that question. And then one for, hi Sam, what did you mean by offsetting should be part of a bigger plan? I think the best way to look at it is we have a long-term journey to net zero, and every year we're trying to decarbonize, and at the end of that year we're taking another footprint assessment of whether we manage to do so. Hopefully we're doing that all throughout the year and measuring, and at the end of that process you will have a decision to make in terms of, okay, I have these residual emissions, they were unavoidable, or I've created this product which has created this environmental damage. Do I want to take a position at that point in the year to go into offsetting effectively is the question you ask yourselves. And if I go and offset that product or my business or any other thing, what claims can I make as well to signal to my audience, employees and supply chain that I am actively engaging on an annual basis with net zero? I think that's part of the bigger plan. And hopefully that covers that one off. How is it possible that credits purchased around $2 to $3 have complied with financial additionality tests? Would anyone like to take that one on?
I'll take a gander at it.
Okay.
More so just because I think that what we're seeing in terms of the market price, we're back in some situations back to levels we were maybe a year or two ago. Those prices certainly went up in 2021. Many of these credits are in the secondary market. So as we step further and further away from the project developer and the originator of the credits, the financial additionality, I think, becomes less relevant. The question then is just to go back to the project itself. And I think that when we're looking at traded prices or even OTC prices, that may not necessarily, that's again, secondary most of the time, that may not necessarily reflect the value on the project developer side. Sorry, Sam, I think I interrupted you.
No, perfectly fine. And there was a general question in the chat about pricing being so low and why is this even across nature-based? We have seen 2021 was a ferocious year and lots of interest in the market, and 2022 was not the case. That we had some global issues and macroeconomic situations that meant offsetting was it is one of those things that part of an annual cycle is you get to the end and make that decision, and people weren't getting to that point. Frankly, they were putting some of their money elsewhere, and as a market you start to see when the demand moves away, these products started to drop in value, I think, across the board. That's probably the best way to summarize that.
Sam, I've seen there's another question on there.
Go for it, Claire.
But it's gone in the chat rather than the Q&A section.
Feel free.
There's one there that says about supporting green hydrogen projects.
Yes, please.
So I think the kind of the answer to that is that maybe one thing I probably didn't stress enough when I was talking is that when one of the hotly debated issues and subjects that we had when we were looking to create the designation is the investment into the projects themselves. Should it be a fund that is purely investing in climate mitigation projects, or is that not feasible? And I think we had we had both an advisory group that helped us build this, and we also went out to a public market consultation. And I think it's one of those points hotly debated and no standard agreement as to whether you should have a fund that was 100% invested in climate mitigation projects, or 70%, 20%, or even if there should be a threshold at all. So where we got to was to say that they should be investing and disclose the projects that are being invested in, the level of those, and then the rest of that fund to be invested in projects that are aligned to our green revenues classification system, so a taxonomy essentially. And I think that is where sort of green hydrogen comes in, because that is, whilst not doesn't have a dedicated subsector itself within that taxonomy, it can be applied in different ways. So I guess the kind of the short answer there is that yes, we do support it, but then there are different ways in which you would get recognised on our markets. And it might not necessarily be through the VCM designation, but it might be through something else which we have, which is the Green Economy Mark. And we provide that to companies and funds that can demonstrate they've got at least 50% or more of their revenues coming from green environmental products and services. So, you know, different options for different types of businesses and funds that come to market.
Thank you, Claire. Zina, and I'm aware that you need to leave relatively soon. There's one question directed at you, though. Could you give some colour on how many market participants are active on the exchange and the volumes cleared?
Yeah. And I'm okay. If we're all willing to stay on a little bit more, happy to do so. In terms of market participants, Air Carbon has north of 150 market participants on the exchange. The level of participation, of course, varies from participant to participant. The standardized and the exchange traded products are still a smaller percentage of the global volume in the market. The global volume, I think last year was something in the range of 300 million tons, and it was quite a small percentage, I think, that was handled by exchanges. On a day, I don't have a daily number. It's only spot. Well, the exchange at Air Carbon is only a spot market. We tend to clear, since we have started, which is February 2021, nearly 2 years ago, we have, I think, transacted something in the range of 17 or 18 million tons. But that is something that's growing. And as the market, as more participants of commodities markets and in more traditional carbon markets, participants get used to exchange traded products and start to transition over to some more efficient settlement mechanisms, we certainly see that number growing quite exponentially in the coming years.
And there's a slight follow-up question to using that as well. Under standard products, how can a buyer get the information on the project they've purchased? I think you demonstrated a bit in your demo there, whereby once confirmed, you can go in there and see the project.
Correct. Yeah. When you're purchasing or when you're buying something off the screen, you're relying on the contract. So the specific requirements, vintage, region, if that's one of them, technology, and so on and so forth. Once you buy it, you have full access to it. It sits in your inventory or on your dashboard. You can go in and take a look. The trade ticket that's associated with the trade has a link as well to see the project. It has the project ID, and you can look it up on Vera or Gold Standard, depending on which registry it is.
Thank you. We're running a little over now, but there's a couple of questions left. Maybe we'll try and tackle those. There's two in the chat that are related to jurisdictions, and there is one in the Q&A that about long-term contracts. So you're seeing commitment for people looking to invest in projects that may only become online in 20 or so years. Claire, would you like to take either of those two, and maybe I can take the other? So maybe it might be slightly early for the fund mechanism, but in terms of long-term investment, perhaps, do you see a lot of interest in people trying to get there?
Sorry, I didn't come off mute quick enough then.
No.
So yeah, look, I think, long-term interest in investing in carbon carbon offsets, and is definitely something that we're seeing when we're talking to many different clients, and particularly sort of the kind of the corporate audience that have got. Think about, you've got the backdrop of regulatory changes, you've got TCFD reporting becoming mandatory, you've got transition plans as well, you've got more net zero targets being set, and and science-based initiatives coming out very, very positive around the role that offsetting can play within that. So I think that you're sort of in a position where you've got some corporates that have ventured into offsetting, and maybe they've done that through a broker's means, and maybe have started sort of on the nature-based project types. And then there's some that actually really at the start of the journey and are talking about doing it in 20 to 30. Whereas I think maybe some of those strategies might be being revisited, to be honest. But then you've also got sort of a segment that is looking at maybe pivoting sort of the strategy away from investing in the nature-based projects, but want to get more involved in carbon capture technology. And so I think there's a lot of room for helping to sort of kind of understand and navigate that world, from sort of understanding the projects and the data, and also just sort of expectations from investors. And I think it's really about being very clear and transparent on how, if you are setting a climate transition plan, and we certainly think that is the way that corporates need to go and should to go, but what's the journey to get there, and that journey being a combination of internal decarbonisation efforts alongside offsetting.
Thank you, Claire. And Tim and Michael's questions are kind of similar around sovereign ownership or jurisdictional projects. Yes, this is a massive talking point at the moment, and as we reach each one of these COPs, it's becoming more and more so. So what projects or countries will issue moratoriums or will take ownership of their underlying voluntary carbon market credits? We've seen examples of countries stepping in to pause issuance, Indonesia, for example, and this is definitely something that we need to be aware of. There's nothing, there's no universal governance on it yet, and that's one of the major issues of the voluntary carbon market in general. But certainly, we anticipate going forward in time we'll have credits that are marked correspondingly adjusted or not, and whether we see the interest being very different in both of them, and both of those types of credits, pricing certainly so as well. So it's definitely something to be aware of as we progress forward, what a country will own and use in its own NDCs. But we have overrun by 10 minutes, and I just wanted to signpost everyone to next week's session. I think it's the same time, the future of the voluntary carbon market and problems and likely outcomes that you may want to tune into, with David Antonioli, CEO of Vera, Peter Viz, Lewis Redshaw, CEO of Redshaw Advisors and Net Zero Markets. Peter Viz, was Pedersen Public Affairs. And I want to say a big thank you to Zeenat and Claire for great presentations, and apologies for mine, but the slides will be available afterwards. So thank you very much, guys, and thank you Net Zero Markets for hosting us.
You watch, if we never, someone's gotta change.